Hey, how are you all? My name is Muhammad Tanvir Aslam and you are watching YouTube channel Asani for all. So today you will learn trade to the forex market and complete understanding of forex market and complete introduction of forex market. The main aim of this course for making money from home. After completing this course, you will able to earn money from home. Basically, this course is compiled into three different languages. First one is English, second one is Urdu and Hindi. For those people who could not understand English language, and third language is French. So this course is basically divided into seven section. Uh, every section have a subsection. So let's start and earn money with forex market.
Hey guys, and welcome to my course. Before we even start, I'd like to thank you all for joining this class. Honestly, it's really appreciated, and I really hope to be able to be a good teacher for you guys and teach you some new stuff by giving you this class. Alright, so once again, welcome to the complete introduction to Forex trading. In this class, we are gonna talk mostly about Forex, and I'm gonna learn you how to trade step by step. Um, so you'll be able to create your own trading strategies and know how everything works. So we'll talk about Excel from scratch, and you'll be able to control it completely. All right, so let's start. So what will be covered in this course? It's very simple. The first thing we are gonna talk about is what's trading. So we'll see in details what exactly is trading, how it works, and everything. When we will see all this, the next thing we are gonna talk about is the broker. I'll show you some good brokers, and you'll be able to choose the right broker. I'll give you all the tips that you'll need to check to be able to choose exactly the right broker for your trading career. Why is it that important? Because if you have a bad broker, you can be a good trader, but at the end of the day, well, if you can't withdraw your money, or you just can't deposit your money, or you have problems with your broker, you'll see it's really complicated. This is why I have a complete class about it. After that, we'll have an introduction to MT4, which is one of the most popular ways. It's a software that you have on your computer. It's one of the most popular in the trading world, especially in the not institutional, but more in the private trading world, or the personal, we can say it this way. Institutions use other programs, but MT4 is really popular for people who just start trading or are trading right now. Next thing we're going to talk about is TradingView, which is another software. Well, not software, in this case it's something that is online. We'll talk about it, and what is it exactly. We'll see how it works. I'll show you some examples of TradingView and everything about it. Next thing we are going to talk about, we'll see the basis of trading. When it's all done, we will have our fundamental analysis. We'll talk about fundamental analysis. What is it? You'll have a complete introduction about it. We'll talk about what are the most important fundamentals. In this case, what exactly can affect the fundamentals, and what exactly can move a certain currency in one way or the other way. When it's all done, we are gonna talk about where we can find the fundamental data. So I'll show you some websites that you can use to be able to get access to this fundamental data and be able to make your fundamental analysis way easier. Next thing we are gonna talk about will be our technical analysis. So we'll see what's technical analysis. We'll talk about all the things that cover technical analysis. This can go from indicators to price action to other things. We'll cover it very in details. I'll show you some live examples. My goal here is really to help you learn by practice. So in many parts of this course, yes, we'll have theory, but I'll try to show you as much as possible live examples on the live charts. So when it's all done, when we will see all this, the next thing we are gonna talk about will be money management. So we are gonna see what's money management and how poor money management can affect your trading, or just when you trade in general. It could be on the forex exchange, it could be on the stock market, it could be on the option market, it can be on any type of market that you trade. If you have poor money management, how it can affect you. All right, after that, we'll put everything together, and our goal will be to create a forex trading strategy. So I'll show you how you can create your own trading strategy, what you have to take in consideration to be able to create your trading strategy. I'll show you some examples of trading strategy, since I assume that all of you guys here have never traded before or have very, very small experience trading. So we'll see how to create a trading strategy, what you need to check. We'll create 2 of them. So this way you'll be able to understand a bit better how exactly you can create your own trading strategy. We'll have an introduction to automated trading. Once again, we'll talk about what's an EA, and we'll talk about hedging. So this course is not about creating robots or expert advisors. This course is really to give you an introduction to trading. So we'll talk about automated trading, since it's part right now of the trading industry, and it's it's actually a very huge part of it. So we'll have an introduction to it, so this way you'll understand what is it exactly, how it works, and everything that is around automated trading. As I said, after that we'll talk about hedging and covering your positions, so how you can protect your capital or the positions that you opened. We'll see some basic hedging strategies. So hedging strategies for you to trade, that you can use to trade, or that you can use to protect your capital, since you can use it in not just one way. You can use hedging in many ways possible. Also, you'll see, I'll explain you that some countries will not be able to use, if you are in some countries, hedging will not work for you, since your broker won't accept it, but in the majority of times it works well. All right, the next thing we are going to talk about is some options. We'll talk about option strategies for forex trading, since you can trade also options when you trade forex. You can trade, for example, options on a certain currency. This way, it's a way, once again, to cover your position, so to protect your capital. Once again, it's just an introduction, since my goal here is not for you to trade options, but it's important. I consider that it's important for you guys to know that it's something that exists and that you can protect yourself with options. And after that, we'll have a small course, an introduction to emotions and how you can control them, since it's very important in the trading world. So this will conclude all our forex introduction, all our forex course, I mean. And from this point, I think you will be able to, by the end of this course, you will be able to, to understand what is trading and be able to trade by yourself. Which brings us to the second point, that is, what is the goal of this course? So as I said, the goal of this course, personally for me, I created this course so you guys will be able to really trade by yourself. I'm not here to try to sell you a strategy that works 100% of the time or whatever. My goal here is really to show you what is trading, how it works, how you can create a trading strategy. So this way you'll be really on your own with a strong basis, and you will be able to create your own trading strategy. You'll be able to create it, to backtest it, to see what works, to optimize it. That's my goal. My goal is not to sell you a strategy, since you'll see that trading strategies that works, even 65% of times are very rare and very hard to create. So you'll see trading is maybe not easy. It's simple, but it's not easy, but it's definitely worth it. So as I said, my goal here is really to help you understand what is it, and to help you start in this world the right way, with the right knowledge. And what will you be able to accomplish by the end of this course? So very simple. You will have your trading account set. You will know exactly how to make a trading analysis. You will know exactly how to trade with fundamentals and technical analysis. You'll know how to open positions, close positions, all the basics. You'll know how to backtest your strategy the right way. We'll talk about some free ways to backtest your strategy that you can use to see if your strategy is profitable or no. And you will be able to do all this by your own. So this is what completes our introduction. So I hope you guys are as excited as me to take this course. Since because when you will finish this course, you'll be able to trade by your own, and you'll have a solid basis about trading. So let's not wait anymore, and let's start our trading journey. Alright, hello guys, and welcome to our second course about Forex trading, where we are gonna talk about what is exactly Forex trading and how it works. So let's start. Alright, the first thing that you guys want to understand is that Forex trading is not the only way that you guys can trade on the markets. There exists a lot of different markets in this world, and there are three popular and a lot of other difference. So let's start with the first one, which is the stock market. So what is the stock market? Stock market, well, a lot of people talk about it, and I think you guys have a small idea about it. But normally, well, stock market is simply a market where you have all the public businesses that exist. And the goal here can be, well, you can trade on the stock market, you can invest on the stock market. There are different ways that you can, well, actually trade there. You can speculate or you can invest. Normally, the stock market, what you can do is, let's say, for example, you buy a part of, you buy a share. When you buy a share of a business, this means you buy a part of this business. In other words, let's say you buy a share of Apple. This will mean that you buy a certain part of Apple. So if Apple drops a new product and the value of Apple goes up, well, guess what? The value of your share will go up. But once again, if something bad happens with Apple and the value of Apple goes down, the exact same thing will happen with the Apple shares. It will go down. So this is a way that you can invest in the stock market. It will be by buying share. It's a very popular market, but it's more harder to work with than the Forex market, because on the Forex market you have some currencies. You have, let's say, if I'm not mistaken, 20 or 25 pairs. But on the stock market you have hundreds and hundreds and hundreds of businesses that exist. Another way that you can invest on, well, you can put money on the stock market will be investing your money. In this case, it's a bit different because you will not speculate. You will, let's say, study a business and you will put money in this business and just let this money work for you. In other words, let's say you bought Apple 10 years ago and you just kept the share and let it, let's say, grow slowly. What happens when you invest in the stock market in blue chips businesses? You will get also dividends, so you'll get dividend payments. This means, let's say you invest $100,000 in Apple, you buy $100,000 worth of shares. Well, Apple will pay you a dividend, let's say, once again, it's just an example, of 2%. This means you will receive 2% just for holding those shares. So just for holding shares, you can receive money on the stock market. And also you will gain money if the value of the share goes up. So if the share value goes up, well, you will gain money, and also you will have a dividend payment once a year, which is, well, as you can see, very, very interesting. So as you can see, those are ways that you can put money on the stock market. The second market that we are going to talk about will be the Forex market. In this case, it's simply the market of money, of currencies. And how you make money on the Forex market, it's very simple. Let's say, for example, you buy a dollar. Let's say the value of the dollar for a euro is 1 for 1. So I know it's not true, but let's hypothetically say that this is the value. So it's 1 for 1. So let's say right now you have your $1, you buy €1. So you own €1. Let's say that the value of the euro goes up, so the value of the dollar goes down. So right now it's one euro is worth $1.10. This means that just by buying €1 and by holding this currency, you made 10 cents for each dollar. So you made a profit of, let's say, well, you made a profit of 10%. This means that, let's say you bought $1,000, 1,000 euros worth of dollars. So you bought 1,000 euros with your $1,000 on day one. On day two, when the value of the dollar went down, and right now it's €1 for $1.10, you just gained $100 just by holding the euro. So you understand right now how works the forex market. Same thing if, for example, the value of the currency goes down. So let's say you have $1 for €1, and right now you exchange your $1 for €1, and the value of the euro goes down. So right now it's $1 for €1.10. So once again, you'll receive less dollars. Then you will get less dollars than you had on the first day because the value of the euro went down. All right, so you understand how you can win and lose money on the forex market. Next thing will be the option market. I don't want to go too much in depth in the option market because it's a bit more complicated, and this course is really about the forex market, but it's very important for you guys to understand it. So the option market, what is it exactly? It's simply a market. It works, let's say, it can be like an insurance. So it's simply a way for you guys to limit your risk and try to maximize the reward that you get. So let's say, for example, we'll stay with our $1 for $1. So let's say you have $1 and you want to buy €1, but you don't want to take risk. You don't want to take a huge risk, and because you don't want to lose your dollar. So what you will do, you will say, okay, I'm ready to buy euros only if the value of the euro goes higher than will go higher than let's say 10 cents. So it's gonna be $1.10 for €1. So only in this case I will buy, let's say, my euro. Let's take a simpler example. You have one share, and you will buy the share only if the value of the share goes higher than, let's say it's $100, it goes higher than $110. So if the value of the share goes higher than $110, you will buy the share. If not, you will simply not buy the share. So let's keep this example in mind. All right, so right now you are buying one option. You are buying the option of buying a share if his value is higher than $110. The value of the share right now is $100. Let's say the value of the share goes to $130. So right now you have the right to buy your share at $100 when its value is $130. So you will earn $30 on your share minus your primus, because this is what you have to pay to take the option. So you just made $20 and you only risked, let's say, those $10 that are the prime. But let's say in the other case, the value of the share goes from $100 to, let's say, $1. So instead of losing $99, you only lost the value of the prime, because that's the only thing that you will guys pay to be able to invest in the option market. Once again, this is the basic of the option market, and it's a very nice thing to use to be able to cover your position. But we'll not talk a bit more in depth about it because, as I said, this course is really about forex market. All right, you also have other markets. In this case, you can, for example, have the oil market, the gold market, the beans market, the soy market, the coffee market. You have hundreds of different markets that exist. And when we will create your account with the broker in our next class, you'll see that some brokers not only offer you the possibility to trade the forex market, but will also offer you the possibility to trade some other markets. It could be the stock market, it could be the gold, let's say silver. You will have the possibility to trade different markets. You'll see. All right. So this is for the popular markets. Right now, you understand that you have two popular markets, which are the stock market and the forex market. You can take options on those markets, and you have hundreds of other smaller markets. Next thing, who are the players in the Forex market? So the Forex market is a very, very huge market. And it's important also to know that it's a zero-sum game. This means if, for example, I win $1, someone has to lose $1. If I win $1 million, someone on the other hand will have to lose $1 million. No money in this market appears by magic. So there is no money that will appear by magic. Someone invested money and someone lost his money. So if someone lose money, someone can win money. And on the other hand, if someone wins money, well, someone have to lose money. So the major players on this market will be the banks and the financial institutions. Those are huge players in this market, and principally what they do is not trading. Yes, they have a trading floor, and yes, they have small departments that trade forex. But the most important thing that they do is they will guarantee exchange rates for businesses. So let's say a business takes a loan of, let's say, $10 million. Well, the bank will guarantee the exchange rate in, let's say, for example, 3 months for this $10 million. So they will pass huge transactions from that has money in it. And this can make the Forex market fluctuate. Because yes, they are not trading. They are simply guaranteeing exchange rates. But once again, this can move the Forex market. The second big players will be hedge funds and investment firms. Those players are very, very, very huge because they have a lot of money, but also they have very experienced traders. They have expert advisors, so they have robots. They trade with robots. It's very automated, their trading. And they have a lot of knowledge. So those are very, very important players to take in consideration. They trade, so their main goal is to trade, is to make money by speculating on it could be the forex market, it could be on stock market, it could be on many, many markets. There are some hedge funds that are specialized on some financial products. So that's the goal of hedge funds and investment firms. And finally, you have the private traders. Private traders are traders like you and me who try to make money by investing in this huge market that is the forex market. So that's for our big players. And right now you understand that forex is it's a zero-sum game, and there is no money that can be printed in the forex market. That is printed in the forex market. Sorry. So right now we want to understand how a transaction works on the forex market. So basically, what you do, you simply when you trade on forex, you simply buy a currency, you exchange a currency for another currency, and for this service, you pay a small fee, which is the commission. If, for example, let's say you are going in a place that exchange money, well, you can go there and exchange your $1 for, let's say, €1, and for this service, you will have to pay a small fee. That's the exact same thing when you trade currencies. You simply exchange one currency for another currency, and for their service, you will pay a certain fee. And your goal here is to make profits. On the other hand, when, for example, you do this on your everyday life, you exchange money, you exchange a currency for another currency. It could be, for example, because you went on a trip or you just visiting another country, so you have to do it. But you can also do this, to win money, so to do profit. And in this case, you will have to work with a broker. So how a transaction works, it's very simple. You open up your account, your account with your broker, and you simply place an order. So your goal here will be to place an order with a certain broker. You will ask a broker to open up a transaction when the value of a currency when the currency will have a certain value. So for example, you want your broker to open up a transaction when the euro will be equal to the dollar. So it's gonna be 1-for-1. So the broker will not open a transaction until this happens. So as I said, the goal of the broker is really to open up transactions for you and close transactions for you. Also, the goal of the broker is guaranteeing the safety of your funds. So when you're giving him funds to be able to trade, well, the broker guarantees the security of your fund. That's his job. And so as I said, the main goal of broker is passing transactions. So guaranteeing that a transaction passes at a certain time and at a certain price, and also guaranteeing the security of your funds. So when you want to withdraw your money, the broker has to give you your withdrawal. It's your right. Um, if there is, well, any other thing that is associated with the security of your capital, the broker has to guarantee this. All right, so right now you know what is forex in general, and what exactly it is, and a bit how it works, who are the main players, what are the different markets that exist. The next goal will be to choose the right broker and create an account to start your trading journey. So that's it for this course, guys, and see you all in our next class. Hello guys, and welcome back to another of our course about trading, the complete introduction. So in this course we are gonna talk about MT4 and how all this how this program works. So as I told you before, MT4 is one of the most popular programs that exists to trade on the forex market. And what exactly we'll do today, we will download this program, and I'll show you how to work with it. So to make the presentation, the download and everything, I will use AvaTrade as as a broker to present you everything, how to download it, how to create your account and everything. If you use another broker, simply download it with the other broker, and then you can just go on MT4. All right, so how everything works. The first thing you guys want to do is simply register here. Click on register now. And if I'm not mistaken, you can directly register with Facebook. When it's done, simply click on the login button right here. All right, when you will be logged in, so as you can see here, when you will be logged in, you can simply go here, and as you can see there, we have an account. So this account is zero funded. It's just a new account. There is absolutely nothing in it, and from this account, my goal is simply to create a demo account. So as you can see, those accounts are real. So Ava real. There is no funds in them. And what I want to do, I want to create myself a new account. So you'll simply click here and click on demo account. When you click on this button, you will have another account. It's gonna be written there, server demo, and this will be your login credentials. Next thing you guys want to do is simply download MT4 terminal. So it's gonna be this button right here. So as you can see, the terminal is there, and from this point you simply execute the program, and you'll see it's gonna work. Simply click on next, and it will work by itself. Alright, I'm not gonna do the download since I already have MT4 on my computer, but you guys will simply have to do this. Alright, when all this is done, the next thing you guys want to do is open up your MT4. You will have a thing like this, so a folder like this. It's Ava MT4. For those who don't use AvaTrade, well, you will just have MT4, but it's the same thing, so it's the same program. All right, so this is my MT4. My goal here is very simple. Right now, what you want to do, since I'm already connected, you guys want to open up your account. So how exactly will you open up your account? Well, it's very simple. You simply want to click on File and log in to a trade account. From that point, what you want to do is simply, first of all, select your server. So what is your server? Here you have Ava Real, Ava Demo. Normally you guys should be on Ava Demo. Where exactly you find your server for your account? Well, it's very simple. It's gonna be there. So you will have your login credentials. So this is where you will enter your login. So your login is those numbers. Your password is the password for your account. And the server that you guys want to choose is the server that is on the page that I just showed you. So the server here. As you can see here, it's Ava Real 2. You should have Ava Demo or Ava Demo 2. So you just select your server, enter your password. When it's all done, you guys should be connected. All right. So this is your main page. Normally you should have only one graph. Me, I have a lot of graphs because, well, I made some analysis. The first thing you should see normally, it should be something like this. So you will have your market watch, if I'm not mistaken. And from this point, we'll learn exactly how everything works. All right, so market watch, what is it? Here are all the currencies that you guys can trade. So it's all divided on AvaTrade. I don't know with other brokers, but I'll talk about AvaTrade about AvaTrade in this thing. So here you have all your currencies. You have other products that you can trade. So as you can see, Brent oil, crude oil, everything. So gold, silver. You have the stock market, some stocks. You have the French stock market. You have the US stock market. You have a lot of markets that you can trade. You even can trade bonds and other different things. So those are all the symbols that you can trade. So this is your, we're not going to talk about the bid price, the ask price, since we have another course on all this. But all your prices are here. Your spread is there. You have absolutely all what you need right here. So all your symbols, all your financial products that you can trade will be there. To open up a trade, very simple. Simply click right click, new order, and you will be able to open up your trade. Once again, we're not going to talk about how to open up a trade since we'll talk about it in another course. All right, after that, if you want to manipulate the graph, it's very simple. If you want to zoom in, it's going to be here. Zoom out, it's going to be there. If you want to select a certain place on the graph, it's going to be this button right here. So let's say you want to look at this place or the place down there. So down here, you have the date. Here you have the price of the financial product. After that, if you want to draw lines, you will have some lines here. So as you can see, you have some lines that you can draw. For example, you want to make an analysis of your price. It's all going to be there. So this is, as you can see, it's very, very simple to use. Next thing, if you guys want to insert some other, let's say, lines or whatever, it's all going to be here. So you have channels, you have shapes, you have arrows, you can insert absolutely anything. So let's say you want to insert a thumbs up. So as you can see here, you have your thumbs up. From that point, after that, let's say you want to work with Fibonacci. Once again, Fibonacci, we're not going to talk about it right now. But just to present you, it's going to be once again here in Fibonacci. And you can insert your Fibonacci there. Some other shapes, you have rectangle, triangle, everything. You have everything here. The next thing we will talk about is, let's say, for example, you want your graph to be in minutes. So when you trade, you can have a graph in minutes. You can have a graph in hours. You can have a graph in days. So let me just present you. Let's say, for example, I'm here. I want to have a graph on minutes. This means that every little bar will be a 1 minute bar. So I will simply click here. If I want a 5 minute graph, 15 minute, 30 minute, 1 hour, etc. until month. So each little bar here will represent 1 month if it's a monthly graph. So as you can see, it's very, very simple to understand. Next thing, the types of graphs. If, for example, you want a graph like this, it will be those candles. If you want a graph, another type of graph, it's going to be here. If you want a graph like this, once again, it's not very useful. This graph is not very useful. But if you want a graph like this, you can have one too. The most popular is, of course, this one. So this is for the types of graphs. So as you can see, you can also do it by clicking on chart. If you want to have zoom in, zoom out, it's all going to be there. So as you can see. What's cool also is that you can control, you can make multiple analysis, which is, you can, for example, choose more than one currency. For example, I want to make an analysis of this currency, this financial product, which is the SPY 500. But I also want to make an analysis of the GDP USD. So I'll simply open up a chart window. And as you can see, it will appear here. So I can just click on it or click on the SPY 500. So it's very, very simple to navigate. Then after that, I can just close it. Besides of that, that's just another way to select your minute, hour, or monthly charts. Besides of that, if you want to add indicators in your chart, it's going to be here. So simply click on indicators. And if you want to add any type of indicator, as you can see, it's going to be there. So you have indicators. But once again, we're not going to talk about indicators right now. We'll talk about it a bit later in this course since it's in the technical analysis part. Another thing which is very nice that you have on MetaTrader is the market. So let's say, for example, you want you want an indicator, or you want an expert advisor. So let's say we'll write down expert advisor. So it will automatically search, and let's say you want products. Well, it's gonna automatically give you some products that you can use, which is very, very cool. Here also, let's say for example, we click on one of those. What's gonna happen? Well, you will be redirected to the market of MQL, and they will show you all the products that exist. So let me show you an example of products. Normally this should give me one product. Once again, we'll have to wait until it loads. And as I said, how it works, since MT4 is not only a trading platform, it's also a community. There are people who are programming things. So as you can see here, you have one product. It costs $500, but once again, it's just an example. Normally you have many other products. So as you can see here, you have different products. You have expert advisors, you have indicators, you have paid products, you have free products, you have absolutely everything. So as you can see here, you have free products. So if, for example, you need to add something, you need to add some add-ons to your analysis, you can do it through the search bar here. Simply write down what you're looking for, and you will have it. Then after that, the money that you will have on your account is gonna directly be here as well. So as I said, so everything will appear there. You will see absolutely everything here on your MT4. Besides of that, as you can see, MT4 is one of the most used trading platforms on the market. It's very, very popular, and as I said, there is a lot of people who are using it. So all your expert, for example, you use automated trading or whatever, it will all be coded in MQL, which is the language of programming of MT4, and everything will be done directly on MT4. So all our analysis will be do them on MT4 or TradingView, but most of the time we'll do it on MT4. So that's it for this course, guys. I hope you now have an introduction to MT4. You know how a bit how it works. What I'll suggest you to do right now is really to play with it. Just look how it works. Just try to get more familiar with it. And after that, you will be able, well, you'll see it's going to be very, very easy. The more you use it, the more it's going to be easy to use. So as I said, that's it for this course, and see you all in our next class. Hey guys, and welcome back to another of our courses about the complete introduction to trading Forex. So in today's class, we are gonna talk about another program that you guys can use to make your graph analysis. So this program is called TradingView, and we will check it out right now. So very simple. First thing I'll ask you guys to do is simply go on Google and then write down TradingView. Then it's gonna be the first one here. Simply click on it, and you will appear on a page that looks like this. So what I like about TradingView is, first of all, that it's very, very colorful. There is a lot of colors, and it's very, very simple for us to understand exactly where things are. So it's more well, for me personally, I think it's more user friendly than MT4. MT4 is very dark. It's more complicated to use. Well, not more complicated. It's just more user friendly than TradingView. All right. So how TradingView works? The first thing you will have to do is create yourself an account. Here I have my account that is there. You have two options. You can have the Pro option that offers you some features, but you can stay with the normal option. Me personally, I use the normal option, not the Pro one. Then after that, let's say you want to add something. Let's say you want to add a currency. So let's go with USD Euro. Euro USD. All right. So let's go with one of the most popular currency that exists. Let's say you want to go with this currency, which is the Euro USD. and you can simply go on the complete graph. And as you can see here, well, you have your graph. The way it works the exact same way as when you are working with the MetaTrader. It's very simple. So first of all, you have here the currency that you want to use. Here you have what type of graph you want. So you can have daily, you can have weekly, you can have monthly. So you can have absolutely everything, which is really nice. Here you have it in French, but I think you should have it in English if you work the same on the same trading view that I am. Then the next thing is the types of graph. So as you can see here, you have a lot of types of graph. In this case, it's Renko graph. It's a bit different, but we'll go with the normal ones. So as you can see here, we have our regular graph. Once again, it's very, very user-friendly. As you can see, the colors are way more user-friendly than that with MT4. Also, what is cool is that you have a lot more options. So for example, here you can go till on seconds, so you can work with second graphs. So one candle will be like, for example, 1 second. Once again, some of those features are more pro features, so you have to pay for them. But for the but TradingView has a bit more features than MetaTrader has to make your data analysis. All right. So the next thing you guys can do, you can add up indicators. Yes, you'll see if you add up too much indicators, they'll ask you to have to take the pro feature. But once again, I think you can add up to 3 indicators to work with on your trading view. So here you'll have all your indicators. Here it's the same thing. So this part right here is really for well, more for stock analysis. For Forex analysis, you'll use more indicators and strategies. Next thing you have is space of work, so workspace, if I'm not mistaken. Here you'll have spaces of work that are already created. So for example, you have this one. It will generate you automatically 3 indicators, and well, it's one space of work, so you will make your data analysis based on this. Once again, it's just, well, you have a lot of other spaces of work that exist. You can create your own, but just to show you that this exists. The next thing that you guys can do is you can replay. So, before that, you can set up alerts. So for example, you can set up alerts on a certain price. You can set up alerts at a certain time. You decide. So as you can see here, for example, you have Euro USD. You can set up an alert at this price, or at a lower price, or at a higher price, which is really cool. And you can have this notification directly on your cell phone, since this app exists directly on your cell phone. Next thing that you can do here is replay. So it's a replay feature. Let's say you want to backtest your strategy and you are interested to replay, replay the candles. What you can do is simply click on the replay button, and let's say you zoom out. You can replay all this data from here. So as you can see here, we just dropped to the 23rd May, which is really cool. You simply click on here. As you can see, the data will be generated. So if you want to make your, as I said, if you want to make your back testing, this could be really, really great. And you can have real-time data right there. Next thing that you have on TradingView, not only the replay feature, you have a lot of other features. If, for example, you want to draw trend lines or any other things, it's all going to be here. So let's say, for example, you want to draw lines. It's here. Other things that you can do, you can add on, you have different types of lines. So as you can see there, you can try them all out. I'm not going to talk about each of those lines, but you have a lot of them. If you want to add, for example, Fibonacci, in this case, we are not going to work with it. It's going to be, if I'm not mistaken, there. So as you can see here, you have Fibonacci, you have different types of Fibonacci. You can add up, for example, a time zone. Work with the, if you need the time zone in your analysis, it's all going to be here, or just the Fibonacci, you can add it there. Besides of that, if you want to draw things, it will be here. So as you can see, I can draw things, which is really cool. If I need to add, let's say, for example, an eclipse, a triangle, or any other forms, it's gonna be all there. I can add other symbols. So as you can see here, I have my symbols. If I need to add symbols to my graph, it's all there also. There is a lot of, as I said, there is a lot of features. You can try them all out. If, for example, I want to clean up my graph, it's gonna be here. So my graph now is clean. So this is for TradingView. That's an amazing tool, especially if you want to do your data, well, your graph analysis, and for your backtesting as well. So as I said, they have the replay feature, thing that doesn't, well, you don't have it on MetaTrader 4. Well, you have it, but it's more when you work with an expert advisor and other stuffs. But with TradingView, it's here it's very simple to use. The only problem with the TradingView is that some features are paid, and that's the only that's the only problem that personally I think there is on TradingView. Once again, you can work with free features, and it works very, very well. So the type of currencies that you can have here, you have absolutely every single currency, you have absolutely every single stock. So you're not limited only to the stocks that your broker is offering you. You have a lot of different currencies and different stocks. What you can do also, you can directly practice your trading there. So you can do paper trading that it's called. So you can just practice your trading here. For example, you replay, you can do paper trading automatically on your trading view. It's just there. Besides of that, for example, you can analyze, as I said, absolutely everything. You can compare two currencies together. So for example, I want to compare the Euro USD to the Euro GDP. I simply click on the compare feature, and I can choose to what exactly I want to compare it. So let's say I want to compare it to Euro GBP, sorry. Here we go. So I have my two graphs, and I can see, for example, if they moving at the same pace, if they moving in the same direction. Once again, this is just an example. So that's a thing that you can't really do with by working with MetaTrader. Once again, you can change the style, you can change absolutely everything, which is a really cool thing. So as I said, TradingView is a really awesome program for you guys to be able to work with. What I suggest you to do right now is simply go on TradingView and just play with it, practice it, add the symbols, delete symbols, learn how it works. Because as I said, if I start to make a complete course about TradingView, it's gonna take me 1 hour. But the best way for you guys to learn this program, because that's not a course about the program itself, it's just to give you an introduction to it, is really to practice with it. So just go on TradingView right now and play with it, learn how it works. And besides of that, when you understand how it works a little bit, next thing we are gonna talk about will be the basics of trading and how exactly it works. So that's it for this course, guys, and see you all in our next class. Hey guys, and welcome back to another of our courses about the complete introduction to Excel trading. So in today's course, we are gonna talk about the basics of trading, not the technical or fundamental analysis part, but really about the basics, how a transaction works, what has to be taken in consideration when we want to open up, let's say, a trade. So the first thing we are gonna talk about in this course will be the pip. So what is a pip value in Forex trading or in general? So very simple, a pip value is simply the fourth number here. So as you can see, we have two numbers. Well, we have 1 euro is worth $1.08 and 25, well, less than a cent. So as you can see here, the fourth value is the value of 1 pip. Why we calculate everything in pips? Well, it's very simple. It's because when we open up a trade, we'll calculate our profit in pips and our loss as well in pip. Everything is calculated really in pip. Don't ask me why. It just works this way. All right. So right now you understand how it works, and well, that the pip is simply the fourth number in the trading. Well, in trading in the currency. So when you look at the currency, it's simply the fourth number. So when we calculate our commission or our spread, which will be the cost of one transaction, it's simply the difference between the buy and the sell. So let's say, for example, you are looking at the Euro USD. your spread will be here. So how do you make this appear? Normally you don't have it. Normally maybe your graph looks something like this. So very simple, your graph, this place looks something like this. So what you want to do is simply add the spread and add the high lows. All right, so the spread here, which is an exclamation mark, is simply how much will cost you a transaction in pips. So for example, if you want to open up a trade of the Euro USD, it will cost you 6 pips. All right, right now that you guys understand this, you want to put all this into, let's say, dollars. How do we put this in dollars? So very simple. What's cool about Forex is that you trade with margin. So as I explained before, when you put $1, your broker gives you access to maybe, let's say, from $10 to $500. So it all depends of the margin that you choose. In this case, well, let's say you open up a volume. You need to understand a thing that is the volume. So in this case, how you understand what's a volume, for example, for the Euro USD, you simply click, right click, and go on specifications. And on the specs, you have the contract size. So let's say you open up a volume of 1. So you decide to open a trade with a volume of 1. This means you buy one complete contract. So you open up a trade on 100,000 euros. So I'm explaining one more time. Let's say you decide to buy. So you decide to make a buy on the Euro USD. This means you speculate that the euro will go up. So the value of the euro will go up. So you buy a volume of 1. Your volume of 1 is simply the value of the contract size. So for example, if it's 1, it's simply 1 multiplied by the contract size. So it's one contract. So you will buy one contract. This means you'll buy 100,000 euros. If your volume, let's say, is 0.1, this means you buy 10,000 euros. If the value of your contract is 0.01, this means you buy 1,000 euros. Once again, that's for the volume. So the volume is simply calculated with the contract size. So a simple way to calculate it, you simply multiply your volume by your contract size to know how much money you will buy. So let's say, for example, here in our Euro CHF, which is two currencies. So your main currency will be the euro, and you are trading the CHF against the euro. So how you are going to trade this? It's very simple. Let's say you will take your volume and you will multiply your volume by the contract size, and this will give you how much money you will put at risk. So in this case, you will put, if you buy a contract size of 0.01, this means you will put at risk 1,000 euros. Well, this is your max risk that you will trade or you will speculate on. Once again, if you have, let's say, $1,000, and you decide to open up a contract of, let's say, 0.01, well, you have enough money. You have enough money to cover your risk. You have $1,000 for 1,000. Well, and you put at risk $1,000 or 1,000 euros. In this case, you will not lose your money. But let's say, for example, you have an account of $1,000 and you decide to open up a volume of 1, which means you open up a full contract of $100,000. This will make your risk grow up, and and the max that you can lose will be $1,000. In this case, if, for example, the value of the currency falls by 1 cent, you will lose your $1,000 completely, because everything is put in together. All right, next thing, right now that you guys understand the volume, you want to understand how you make profit or how losses happen. So let's say we take a graph. So this graph is the Euro USD graph. You can open it. And what we are going to look at is, let's say we want to open up a buy. So we can open up two types of transaction in the Forex market. The first one is a buy order. So you buy the currency. In this case, you will buy the euro. So let's say you are somewhere here and you speculate that the value of the euro will go up. So you decide to buy the markets here. You buy your euro there, and the value of the euro goes up. You buy a full contract, and let's say you make a profit of 100 pips. This means, well, how much money you've made. So if your profit per pip is $10 because you opened up a volume of 1 and you opened up a contract of 100,000. This means if you make the calculation, your profit or loss per pip will be around $10. If you made 100 pips of profit, this means you made $1,000 of profit. How I calculate this fast? It's very simple. You take your lot size, which is, for example, in this case, we'll say 0.01, and you want to calculate how much how much this will cost you. So you simply take the last decimal. In this case, it's 0.01, so it's gonna cost you 1 cent per pip. 10 cents per pip, because you will multiply it by 10. So if I open up a contract of 1, it's gonna cost you $10 per pip. It's as simple as this. And once again, it's just an approximation, because depending on the currency, it will depend a little bit, but it's gonna be around $10 per pip. Once again, as I said, it's an estimation. The calculation is a bit more complicated, and normally it's a bit more or a bit less, but it's around, let's say, $10 per pip when your volume is around 1. So when it's 1, it's something around $10 per pip. So very simple. If you want to calculate how much money you will make per pip or lose per pip, as I explained, you can calculate it this way. So if it's a volume of 1, it's going to be around $10. If it's a volume of 0.1, well, 0.01, it's going to be around, let's say, $1 per pip. So if you open up your trade here, let's say it's at 1.08, and you close your trade at 1.09, you just made 100 pips, which is 1 cent. And this 1 cent will give you $100 if you opened it up at a volume of 0.1. If you opened up this trade at a volume of 1, you would have made $1,000. Next thing, how can you lose money? Well, it's very simple. Let's say you're here at something around 1.09 dollars per euro, and let's say you decide to open up a buy order here, and the value of the dollar fell. So if here, let's say you close your trade there, so it fell by 75 pips. So what just happened? You just lost 75 pips. This means if you opened up your trade at 0.1 of volume, you lost $75. How I calculate this? Well, I lost 75 pips. I multiply my 75 pips by, 75 pips. I multiply it by $1 per pip. This means I lost something around 75 pips. But don't worry about the calculations of all this. When you open up a trade on, let's say here on MetaTrader, it will automatically say you how much money is at risk and how much money you can possibly win or lose, depending on when you put, where you put exactly your stop loss or your take profit. All right. So right now you understand that you can do the first thing, which is a buy order. The next thing you can do, you can open up a sell order. In this case, let's say you are somewhere here and you decide to, and you want to make money because you think that the markets will fall down. So what you will do, you will open up a sell order. In this case, it's just there. Let's say I decide to open up a sell order. It's very simple. As you can see, the order has been opened. So what it means? It means for every pip for every time that the market goes down, if the market keeps going down, I will make my profit. So in this case, for example, if I open up my trade here, every time that the market falls by 1 pip, I will make $1 because the volume is 0.1. So if I'm somewhere at 1.11 and the market falls at 1.10, this means I lost 100 pips. This means I lost something around $100. Once again, as I said, it all depends of the currencies. It all depends of what currencies you will trade and what currencies are involved. But usually when your main account is in USD dollars, it's going to be something around, for a volume of 0.1, it's going to be around $1 per pip. But once again, it all depends of currencies. It can be sometimes a bit more, it can be sometimes a bit less. It's after that, you have to make the calculations. So, but theoretically, if it failed by, let's say, as I said, 100 pips, I just lost $100. I just won $100. And in the other case, if, for example, I open up a sell order here and the markets go up, I will lose money. So why? Because I opened up a sell order, which is only profitable when the markets are going down. I'm not gonna explain how works a sell order and what is like, because it's a bit more complicated. But just for you to understand, if the markets go up, you open up a buy order, you buy the market, so you buy the currency. And if the markets go down, you simply sell the currency to buy it a bit later. That's the goal. So let me explain it. Let me try to explain it. How works the buy and the sell. So when you buy the currency, the first thing, let's say you want to buy the currency. When you click on the buy button, the currency goes up. But to close your transaction, you will sell your currency. Once again, it looks a bit complicated, but everything, the only thing that you have to understand is if the market goes up, simply click on buy. If you think that the markets go down, simply click on sell. That's it. So that's for the two types of orders that you can pass when you trade the Forex market. All right, so right now you understand how all this works. Next thing is the commission. How you calculate how much commission you will pay. So as I said, your commission is here in pip value. How you will calculate the cost of your trade. So when you open up your sell order here, the cost of your trade will simply be, let's say in this case, I will win $1 per pip. So if I open up my trade, it's gonna cost me, well, in this case, it's 0.6 pip. So it's gonna cost me 60 cents. Why? Because once again, here, the value is in pipettes. So in this case, it's written 6, but it's not 6 pip. It's 0.6 pip. Why? Because here, what they write is simply the value, the difference between this value and this value. And the difference between those two values is 0.6 pip. So it's very simple. As I said, how much my trade will cost me. In this case, it will simply be 0.6 multiplied by how much I win or lose by pip. So for example, if I make $1 per pip, well, in this case, my commission will be 60 cents. In this case, my commission will be $1. Here too is going to be $1. Here is going to be $1.50 with a volume of 0.1. If, for example, I trade a volume of 1, this means that my trade will give me, or I will lose $10 per pip, or something around $10 per pip. So here, my trade will cost me $10. Here, my trade will cost me $7. Here, it's going to cost me $44. So I hope you get the point. All right, next thing that we are going to talk about, once again, we saw our contract size. Next thing that we will talk about, as I said, will be the swap. So another very important thing for you guys to take in consideration is the swap that you can trade. That you will have to pay in case that you decide to invest in a certain currency. So let's say, for example, I decide to open up a trade, I don't know, here. I decide to keep the trade for, let's say, 1 week. And I opened up a trade at a volume of 1. This means I got access to 100,000 euros. But when you, let's say, go to the bank and decide to loan money, so you go to the bank, you take money, you need to pay interest on this money. So it's the exact same thing on the Forex market. Let's say you open up a trade with a volume of 1. This means you got access to $100,000. And the cost of this money, of this $100,000, will be, if you decide to buy the 100,000 euros, it's going to cost you 4.26% yearly. So you will pay 4.26% on your contract yearly, but on a daily basis. So it's going to cost you something around $4,260, but you will pay for this amount daily. So every day you will pay let's say a small percentage of all this. This is for the swap. You have the swap long, so this means when you buy, long it's buy. So when you buy the market, that's your swap. So this is how much it will cost you to hold a buy position or a long position. And this is the swap that it will cost you, the interest that this will cost you to hold a short position or a sell position. So in the first case, in the Euro USD with AvaTrade, your swap cost, so for example, you opened up a transaction here, a buy transaction, and you kept it for, let's say, 2 or 3 days, it will cost you 4.26% to hold it yearly, but you will pay this on a daily basis. So you will pay a small amount on a daily basis. Normally the swap can be positive or negative. In this case, it's negative, but you have some currencies that they have that have positive swaps. So let's say, for example, you open up a trade and you will receive money on a daily basis because you hold the position. But once again, it's not all currencies, and usually the currencies that have positive swaps are more risky. But once again, it depends. With AvaTrade, usually it's this, and you can see this as dividend payments or as interest. It's because it works a bit the same way. It's not a dividend payment at all. It's really positive interest that you can receive. For example, if you open up a transaction on a currency that have a positive swap, it's simply an interest rate that you guys will receive just for holding the trade. But once again, and it's paid daily. But once again, it's not a dividend. It's just an interest rate. The same thing if you open up, let's say, a trade with a negative swap. That's what's gonna happen. You will simply pay an interest rate because the swap on the currencies is negative. So this is how works the forex trading. So let me just summarize everything that we just saw. You can do two things in trading in general. You can buy the markets or sell the markets. When you expect the markets to go up, you buy the markets. When you expect the markets to go down, you sell the markets. After that, if you want to understand how much your volume is gonna worth, you simply look on contract size. So in this case, for example, your contract size is 100,000. So this means if you open up a volume of 1, you will open up a contract. You will take $100,000, 100,000 euros here. So it's your margin currency. You will take 100,000 euros. This means you just bought this amount of euros. For the rest, how you calculate, well, how you see how much the transaction will cost you, it's gonna be here. So this is the value in pipet, which is the last digit here. And you simply, well, it's 0.6 pip, 1 pip, 1 pip, 0.7 pip. So it's gonna simply cost you your volume multiplied by, well, it's gonna cost you around, so here it's gonna cost you 60 cents, it's gonna cost you $1 if you open up a volume of 0.1 once again. So very, very simple to understand. Once again, it's all a question of practice. The more you practice it, the more you'll see it's gonna be easy. A last thing that we didn't saw yet, and that is very important to understand, is the margin, since you always have to leave a certain margin when you trade. So let's say, for example, you have an account of $100,000. Well, I'm sorry, $1,000, and you decide to open up a trade of $100,000. First of all, your broker need to give you access to this $100,000. And in some cases, with only $1,000, the broker won't give you access to this amount of money. Why? Because it's very simple. When you open up your account with your broker, let's say, give you access for $1 that you put in your account will give you access to $20. In this case, if you have a $1,000 account, the max amount that you can trade will be 20 multiplied by how much you have in your account. So it will be $20,000. This means the max volume that you will be able to trade will be 0.2. Why? Because the broker give you access only to $20 for each dollar that you put in your account. In let's say another case, the broker gives you access to $500 per dollar that you put in your account. So it's gonna be one for $500, your margin. So this means if you put on your account $1,000, the broker will give you access to $500,000, and you will not have to put a huge margin on each of your trades. So the more the broker gives you access, the more money the broker gives you access to, the less margin you will have to leave, for example, to trade. But the less the broker gives you access to money, the more margin you will have to leave to trade. So once again, you'll see this when you put your first trade. You will have to leave a certain margin. For example, let's say in the case that you have access to $20,000 with $1,000, this means that you will have to leave as margin $1,000 each time that you open up a 0.2 trade. So each time that you get access to $20,000. So let me just explain once again. Let's say you decide you have $1,000 and you decide to open up a trade of $10,000, and your broker gives you access for each dollar that you put on your account to $20. This means that if you open up a trade of $10,000, which is a volume of 0.1, you will have to put a margin of $500,000. because with 500,000, sorry, you will have to put a margin of $500, because with $500 you have access to $10,000. This is simply the calculation that you do. So as you can see, those are the things that we saw today about the forex. So right now you understand what is the commission that you will pay, that you can do two types of transactions, you can buy or you can sell, that you need to take in consideration the swap, and you need to take in consideration the margin when you make your forex trades. So that's it for this course, guys. Right now that's the only basic that you need to know. The next thing that we are gonna talk about will be fundamental analysis, and we will see this in our next class. Hello guys, and welcome back to another of our courses about Forex, the complete introduction. So in today's class, we are gonna talk about our first way of making the analysis of a certain currency, and this will be the fundamental analysis. So my goal in this course is really to give you an introduction to this type of analysis. So what is fundamental analysis? Theoretically, it's something very simple. It's simply a way of looking at forex markets by analyzing different types of data, which could be economical, social, or political data that will have an effect on the supply or the demand of on the supply and demand of a certain currency. In this case, this is very general. So let me just give you an example. Let's say, for example, that the interest rate. Let's take the interest rate, for example. Let's say the interest rate goes up. This means that the currency, the certain currency that is associated with the central bank that put it up the interest rate will simply become stronger. This means that loans, there will be less loans because the interest rate is higher. This means people will invest more in the market of bonds because the interest rate is higher. This means people will invest less in the stock market because they can gain more money by investing in bonds with the less risk. And this will have a direct effect on the currency as well, since all those markets are linked to the currency, to the forex market of the certain country. So let's say this happens in the US, the interest rate goes up. Well, necessarily because of all those factors, the US dollar will become way stronger. Same thing if, for example, the interest rate goes down. Well, the US dollar technically and once again theoretically will go down because of all those factors. And the interest rate is just one between many of them, but it's a way to calculate to see, for example, to see that the currency will become stronger or weaker. Another way to explain what is fundamental analysis, it could be looking at all the macroeconomics around a certain country. So for example, let's say I analyze the US versus Europe, so the euro versus the USD dollar. I will look at macroeconomical data for the US and also for the countries in Europe, the biggest countries that are in the European Union. And this way I'll be able to have an idea about what's gonna happen in the markets. How this type of analysis can affect trading? It can directly affect trading. So let's say, for example, let's take right now, which is we are in the time of COVID-19 when I'm shooting this class. For example, the COVID-19 had a direct effect on all the markets. If you looked at, let's say, the stock market, the US stock market, you could see that it never been so low. It went really down and then it come back up. Same thing for the currencies. The volatility, on the markets has never been so strong. So the currencies, there is a lot of uncertainty when huge things happen like this. So as you can see, fundamentals can be a set of it could be a lot of things that are included in fundamental analysis, but principally how it will affect trading, as I said, it will increase volatility, it will move the price to extreme areas, so it can go really high as well as it can go really low. Um, so it's very something really really strong. It can be neglected, and it's all around macroeconomics. It's not something like technical analysis that is very very, like, let's say, on chart. It's very something. It's something that is very general and very around politics, all economical stuff, all social stuff. What are the things that are taken in consideration in fundamental analysis? So as I mentioned before, it could be, well, as I said, let's say political data. Let's say we talk about all the problems that are happening in the world. Let's say a country invades another country. Well, necessarily this will have an effect on their currencies. Let's say a country is in a economical warfare with another country. So there is an economical war between two countries. This will have an effect on currencies. What else? It could be something as simple as a tweet of the actual US president, which is Donald Trump. Let's say he puts a tweet. Well, this will have a direct effect on the USD dollar. Not only on the forex, well, it will not only have an effect on the forex market, but also on the stock market. If we talk about all social data, let's say the unemployment rate goes up or down. Let's say the interest rate goes up or goes down. Let's say, for example, a certain sector that performed well in the past quarter right now doesn't perform well. Well, it's gonna have an effect, a huge effect on currencies, on the currency of the country. So there is a lot of things that can be included in fundamental analysis, as I'm explaining, but mostly of the things can be economical, social, or political. So those are the three main things that are included in fundamental analysis. But there is a lot of small things that are included in those big main things. So those are all the things that can affect the fundamental analysis, and that we will have to look for if we want to make a complete forex analysis of our chart. So for example, if we want to make a complete analysis, the first thing that we will do is make a fundamental analysis. Then after that, to enter the markets, we'll make a technical analysis, and then we'll enter the markets. And if our fundamentals and our technicals are telling us to go in the same direction, for example, it will go up, well, this, you have more chances to have a winning trade than if the fundamentals doesn't support your technicals. Last thing, is there other types of analysis? Yes, there are other types of analysis. You have technical analysis and sentimental analysis as well that exist. We're gonna talk about, well, in this course we're gonna talk mostly about fundamentals and technicals. What are technicals? Technicals, we are gonna talk about it in the next few classes, but usually it's very different. Which fundamental is very like macroeconomic. It's all about news. It's all about what's happening in the world. It's all about what's happening in the country and everything. And technical, it's all about the graph. So we are just working with the graph. It's very let's say it this way. It's very microeconomic. It's very on the graph, not like the fundamentals, which are really about the whole situation, the whole, let's say, country and everything in general. It's not very, it's not precise as it's for the technical analysis. So right now you understand what is the fundamental analysis, and we'll talk a bit more in details about it in our next classes. Hello guys, and welcome back to another class of our course about the complete introduction to forex trading. So in today's class we are still talking about fundamental analysis, and we are gonna see what are the most important indicators, what are the important indicators for fundamental analysis, or to complete a good fundamental analysis. So let's start. So first of all, as I said, the fundamental analysis is all about macroeconomics. So the first indicator that is very, very important, not only for me but for everyone, is the GDP, or the gross domestic product. It's simply a monetary value of all finished goods and services made within a country during a specific period. What does this mean? It means let's say, imagine the US, and all the products that are produced that are made in US are counted in the GDP. Also, the GDP can be for the whole country, but can also be per citizen. So let's say for each person that is living in the US, the GDP will be somewhere around, if I'm not mistaken, something like $50,000 or $60,000, which is per citizen, and you have the GDP for the whole country. The GDP is a huge indicator for fundamental analysis, because if it goes up, this means the economy of the country is strong, and it means that the currency of the country will also be strong and will become stronger. In the other case, if for example the GDP goes down, well, it means simply that the economy of the country is not that strong, and the value of the currency will simply go down as well. Also, the GDP, as I said, it can be calculated two times in two ways, for the whole country, but also per citizen. Let's say, for example, if we take the US, yes, the GDP for the country will be huge, but the GDP for a citizen will also be huge. If we compare it to the GDP of India, you'll see that the GDP of India is almost as huge as the GDP for the country is very, very huge, close to the US one, but the GDP per citizen is way much lower. So this is for the GDP. As I said, it's one of the most important indicators that exists. The next one will be the interest rate of central banks. What is the interest rate of the interest rate of central banks? Very simple. It's the interest rate that the central bank will use to lend money to other banks. So this interest rate will define how much will be the interest rate in the country. Let's say that smaller banks will lend money to normal users. So let's say, for example, the interest rate of central banks is 2%. This means they will lend money to other banks for a interest rate of 2%, and those banks will lend this money to normal users or to other people for more than 2%. So everybody will make a certain profit. How this can have an effect on our currency? Well, it's very simple. Let's say, for example, that the interest rate goes up. This means that the currency is stronger because you have less people that borrow, and people will invest more in the bond market because the interest rate of the central bank will have an effect on the interest rate that is on bond market. And this means that people will invest more in the bond market. This means that the economy or the country will become way much stronger because people are investing in the bond market of this country. On the other hand, if, for example, the interest rate goes low or becomes lower, normally and theoretically, this means that the value of the currency will decrease because people will take their money out, will use more money. There will be more money on that will be used, and this money usually goes and is invested on the stock market because it's more risky. So people don't want to put money, don't want to keep money in banks, don't want to invest in bonds. They take money out. This is why the value of the currency normally goes down. Well, a bit lower, will go lower. But normally, theoretically, it's not always happening, but in the majority of times, this is why. Next thing, the unemployment rate. So what is the unemployment rate? It's simply the number of unemployed people. Well, put it in a percentage in a certain country. So usually, normally in the US, the unemployment rate is something between 5 and 9%, something like this. Sometimes it's a bit lower, sometimes it's a bit higher. But normally it's something around, as I said, 5 and 9, so it's something between 6%. Once again, this has a huge effect on the value of a currency because the people who are working are the people who are making the economy run, and if there is too much people who are not working, this has a direct effect on the currency of a certain country because it brings out other questions. People who want to buy this currency will ask themselves, is this country secure? is this something? Is this a recession that is preparing, or like other questions, and this will make the currency go down. So this is why the unemployment rate is a huge factor and a huge indicator for fundamental analysis. Once again, it's well, as I said, it's the people who are not working, put it in percentage. And when the unemployment rate goes down, so for example, there is less people who are not working, so more people are working, that's a good thing. And if the employment rate goes up, well, that means that, well, the economy is going a bit more badly. And this means that the value of the currency will also go down. Next thing will be the inflation rate. Well, every year you have a certain increase in prices, a certain increase in everything. And this is all because of the inflation rate. So if we talk from, well, the definition of this in a theoretical way will be simply a sustained increase in the general price level of goods and the services in an economy. So let's say, for example, that the inflation rate of a certain country is 2%. This means that the value of all the products in this country will increase by about 2%. Yes, in certain industries it's gonna be more. In other industries it will maybe not increase at all. But once again, it's just the average of all increases that will give you the inflation rate. So as I said, let's take the example of that country that has an inflation rate of 2%. Maybe the value of, let's say, meat will increase by 4%, but the value of, let's say, vegetables will not increase at all. But once again, it's just an example. So as you can see, the inflation rate is simply by how much the value of a certain product or of all products in this country will increase year by year, and it will also lower the power of the buying power, the purchase power, the buying power of people who owns the money. So let's say you have 1 million today. Well, this $1 million will not worth $1 million in 1 year. In 1 year, this $1 million will maybe be worth, let's say, $900,090. And once again, it all depends of the inflation rate in the country. So your buying power will decrease over the years because of the inflation rate. So those are the four major indicators, fundamental indicators. But as I said on the last one previous course, there are other important political and economical news that can affect our fundamental analysis. As I said, for example, let's say the president of the US right now decides to make a tweet. Well, this will definitely affect the US currency, maybe in a good way or maybe in a bad way. Let's say, for example, there is a war or something somewhere. This will directly affect the currency. Let's say, for example, something happens. Let's say the oil industry, for example, right now it has a problem. This also has an effect on the currency. So there is a lot of factors that can affect the value of the currency of a certain country. Once again, those are the four main indicators for to make a good fundamental analysis and to have a good idea of if the currency will go up or will go down. So that's it for this class, guys, and see you all in our next class, where we are gonna talk about the places where you can find information about all those this fundamental data. Hello guys, and welcome back to another of our courses about the complete introduction to Forex trading. So in today's class, we are gonna talk where we can find fundamental data to be able to complete a good fundamental analysis. So I will suggest you some websites that I personally use to be able to go look for this data, and if you have some other websites, they are good as well. Alright, so the first website we are gonna talk about is TradingView. So TradingView is once again an amazing place where you can find fundamental data, not only technical data, and you can find what I really like about trading view is that you have this data directly on your chart. So let me show you an example. So here, for example, we have the NZD CAD, which is the New Zealand dollar versus the Canadian dollar. And as you can see here, you can have all the news that are upcoming. So for example, here, if I'm clicking there, I can see that the 28th of April, I will have two news that will be for the New Zealand dollar. Same thing for the Canadian dollar right here. If I select, let's say, another currency, which will be the USD CAD, which will be the US dollar versus the Canadian dollar, I can see all the news that are coming, the time where they will come. So for example, here I have the GDP Coons spending advances, which is a US news. I have a Canadian news that is coming here. I have a US news that is coming here. So I have all my news and I'm able to know exactly when they will come in application. Well, when exactly they will appear. Also, what is cool, if for example I want to backtest my fundamental strategy, I have a strategy that is strictly based on fundamentals. I can simply replay my graph. Let's say for example I put it in on daily, and I can simply replay my graph from, let's say, here, and I will have access to all the news that have been existed since the day that I want to replay the graph, and I can directly test my news and see what news have the most effect on my trading. So let's say for example there is a certain news that I want to try, or I want to, let's say, backtest, verify if they have a certain effect on the market conditions. I can simply replay my chart and look where exactly those news are and what type of effect they have on my chart. Alright, so this is our first place where you can find fundamental news. The second place is investing.com, which is once again another amazing place where you have absolutely everything. You have you have all the stocks and all the stocks, currencies, foreign exchange. You have absolutely everything. You have also insights. You have another thing, which is they offer, there are people, there are analysts who write down their analysis, what they think will happen in the markets, which is really, really cool. Also, not only you have this, but you also have an economical calendar here, which is a really cool thing. And if you want to learn more about trading, you have webinars, you have trading guides, you have a lot of different things. And what is cool also about this website is that it's completely free. All right, next thing we are going to talk about, or next place, is Daily FX, which is the place for Forex trading. What you have here, you have trading strategies, you have blogs, you have people who share their knowledge about Forex. And what I really like about this website is their economic calendar. So as you can see here, I have, let's say, last 7 days. I can have all the news for the last 7 days, for example, and from the country, all the countries. And if I want to select some countries, for example, I can select just the countries that I'm interested in. For example, I just want to have the US and the Canadian dollar. So I will unselect absolutely everything. I will just keep the USD and the Canadian dollar. And what will happen is that I will only receive news for the USD and the Canadian dollar, and I will be able to, let's say for example, trade the USD versus the Canadian dollar. Also, I can have the importance of the news, if the news are very important or they are lowerly important. I have all the dates that I want. Also, I can go back in time, and I can use this tool to backtest my fundamental strategy as well as on TradingView. If for example the data is not on TradingView, you will find it here. Next place, the next websites that we are gonna see are strictly news websites. So the first one will be MarketWatch. Once again, that's a news website, and you have absolutely everything on it. So you have all types of news. You have political, you have economical, you have social news, you have absolutely everything. And it's really, really, really focused on the trading part. So when you will read the news, you will be able to make yourself a certain idea if for example your currency that you are trading will go up or will go down. And once again, it's all about reading them and looking at charts and looking what effects had a certain type of news on the movement of a certain currency. That's the exact same thing for the next website that we are going to talk about, which is Reuters. Here you have absolutely everything. You have like it's a website that is really based on news, but economical news as well. So once again, when you come here, you can read all the news that they have, and this is a great way also to find out fundamental news. Next website, Bloomberg, very popular. We're not talking about the Bloomberg terminal. We are talking about the Bloomberg, so the website. Once again, an amazing place for economical data and economical news. You have everything here, from forex market to stock market to bond market to absolutely everything, from analysts that are talking, from just people who are writing down what they are thinking. You can create your own watch list. There's a lot of good things that you can do with the Bloomberg website. Once again, I really suggest you guys to go take a look at it. So those are the first websites, and the last websites that we are gonna see today is the Wall Street Journal. So Wall Street Journal is well, for those who doesn't know, it's one of the most important economical websites or news place that exists. And once again, they have all that you need. You can go from economics to politics to business to real estate, absolutely everything. You have once again charts, you have everything you want. That's another great website and great reference that you guys can use to be able to go and check for the news, to read news and to be able to make your fundamental analysis. So as I mentioned, the three websites that offer the websites that offer you news directly on the graph will be Trading View, which has all the news that are directly on the chart. So this is my favorite. Personally, my favorite is this one because I have all the news directly on chart, and this one right here, which is Daily FX, because of their economic calendar. Yes, they have an economic calendar on investing.com, but I really like the Daily FX economic calendar. He's very completed. So those are my two favorites. After that comes investing.com. And then you have those other websites who offer you good news and good references to be able to read good and interesting economic articles. So as I said, guys, if you have to remember something from this course, before doing your technical analysis, do your fundamental analysis. And how you can do it, very simple. Simply come back on TradingView and look at what type of fundamental data will appear soon. So let's say, for example, we will see the GDP that will appear in the next, let's say, 2 days. So maybe it's not the time now to open up your position. Maybe you'll have to wait 2 days and then open up your position. Or if you want to trade the news, maybe you can make your researches, look if the GDP will increase or decrease, and all this type of things. Once again, it's all about practice, and the more you do it, the more it's gonna become easy. So as I said, TradingView, amazing place. So I really suggest you guys to go take a look and work with their news that are directly here. If you want to backtest a certain news, for example, you want to backtest the unemployment rate and see how the market reacted to the unemployment rate announcement on the currency, you can do it directly on TradingView. If you want all other news, I suggest you the Daily FX economic calendar. You have all the economical news there in a calendar, and you will know exactly when they appeared. And finally, investing.com, also a very good source for all this. They also have an economic calendar that is very interesting. Finally, all the other websites that I suggest you guys, it's to be able to read good and quality information about economics, political, and other stuff that can have an effect on your fundamental analysis. All right, so that's it for this course, guys, and see you all in our next class when we will start our technical analysis part. Hello guys, and welcome back to another course of our class about the complete introduction to Forex trading. In today's class, we are gonna talk about technical analysis, which is very different from fundamental analysis. So we are gonna see what is it. We are gonna talk about the three things that we are gonna use in this class, that will help you learn how to trade a graph and how to trade the Forex the right way by using technical tools. All right, so let's start. So the first question that we are going to ask ourselves is, what is technical analysis? And well, what exactly is it? So technical analysis is simply a trading discipline employed to evaluate investments and identify trading opportunities based on the statistical trends and simply on the chart. So what does all this means? That's a bit complicated, sound complicated. It's simply working directly on the chart with the use of technical tools. What are those tools? Well, you can use indicators. You can use price action, as you can see here. You can use support and resistance. You can use Fibonacci. You can use different strategies that are based strictly on a technical point of view of trading, so no fundamental. So this is as I said, this is a technical analysis. So basically, we will use three things in this course to be able to perform a technical analysis. The first one will be technical indicators. And to understand what's a technical indicator, it's simply a mathematical calculation that is put directly on, that is presented with an indicator. So let's say, you have different types of indicators. We'll talk about it in next class. But basically, it's simply mathematical calculation that tries to identify patterns, that try to identify price movement, and will try to predict you a certain range of price, or if the price is overbought or oversold, or if the price is, for example, in a bear market or in a bull market. So those are that's the goal of indicators, and we'll use them especially to be able to give us entry signal and to be able to take certain trades. So this is for indicators. The second thing will be chart patterns, and chart patterns will be, for example, what's here. It's working directly with the candles, so we'll work with candles, and there are patterns in candles that happens a lot of times, and those patterns can be used to predict if the price will change or if the price will stay the same, and what's gonna happen on the graph, simply by looking at them and spot them. So chart patterns, will be very, very used in our course. So we'll principally work with indicators, but I will also present you chart patterns and price action. This way you will be able to create your own strategy after that. Last thing will be price action. In this case, you'll see chart patterns and price action. You can put them in the same category. I personally put them in the same category. The only difference is that chart patterns, for me personally, is when you work directly with candles. So for example, you have candles that, you can have two candles that will predict that the price will fall. Some predict that the price will go up. And price action will be really things like, for example, support and resistance, Fibonacci, and all those things that are not necessarily indicators, but directly on the chart. So you will take a chart with no indicators, no fundamentals, nothing. You will put your support, your resistance, and you will work with the chart patterns. You will work with trend lines, and all this can be in chart patterns and price action. Price action will really be like trend lines, support resistances, will be especially all the trend lines and all the points, like let's say strategical points that you can put on a chart. Once again, that's just the introduction. We'll have some live examples in the next few classes. But for now, just for you guys to understand that there is three things that are very important in technical analysis. So as I said, indicators that are mathematical calculations that are used to predict the future price of a certain currency. You have chart patterns, which are the things right here. So those are just some examples. So you have, for example, evening doji star right here, evening star. Those are patterns that will show you that the price will fall. You have different, in the chart patterns, you have some that are very reliable, others that are less reliable. And once again, it's all speculation. So the goal here is really to maximize your, let's say, winning rate. And by using them, it can help you. And the last thing will be the price action. And the price action, well, it's, as I said, simply the support, the resistance, the use of trend lines, and other things like this. So that's it for the introduction. Right now you understand all the tools that we are gonna use. Now it's time to use them on a real chart, and that's what we are gonna do in our next classes. So we see you all in our next class, guys. Hello guys, and welcome back to another course of our class about Excel, the complete introduction. So until now we saw what's a technical indicator, and in this class we are gonna talk about the important technical indicators in trading. So we are gonna saw it in a theoretical point of view, and then we are gonna go on live on a chart, and I'll show you how to generate those indicators on your chart. So let's start. All right, so first thing that you guys wanna talk about, well, first thing that we have to understand is there is 4 types of indicators on our, well, on your chart, or 4 important types of indicators that exist. The first one will be the trend indicator. Those are 2 examples. So you have the MACD and the parabolic SAR. Both of them can be considered as trend indicators, since the goal of those indicators is to tell us if the trend is an uptrend or a downtrend. For example, the value of a currency is currently going up or down. So this is the goal of the trend indicator. It's really to indicate us if, as I said, a certain, as I said, a certain currency is going up or down. The second type of indicators that exists will be the momentum indicator. In this case, we can talk about the RSI and the stochastic. Once again, don't worry, we'll see it in live a bit later in the course. So those 2 indicators, their main goal is really to tell us when exactly the trend will reverse. So for example, when the downtrend will become an uptrend, and when the uptrend will become a downtrend. So mainly those 2 indicators will show us when the markets are overbought or oversold, and they can be used as confirmations to be able to open up a position. So let's say, for example, we can use those 2 indicators to be able to, let's say, have a entry signal in our trading. So next indicator will be the volume indicator. Once again, we are not gonna trade a lot with volumes, but a very interesting indicator, like very interesting volume indicator that exists, will be the money flow index. So the goal of this indicator, I personally use it more in stock trading, is to tell you how much money is currently traded, or the volume of trades that is currently, let's say, on the market. And the more there is money that is injected, the more the movement of the price will be high or low. But once again, we are not really gonna use the volume indicator in our trading strategies. I personally don't use it, but once again, it's you can use it. I'll show you how to use it, and you can personally use it. All right, so the last one will be the volatility indicator. I really like this one because it shows us, for example, if there is a lot of movement in the market, the volatility indicator will show us that, okay, there is a lot of movement in the market. You can enter a position right now, and you can make, let's say, there is more risk when the volatility is high, but you have more chances to make a lot of money. And a very popular indicator will be the Bollinger Bands, which is once again a very good indicator to talk about, that can show us if there is volatility in the markets or there is no volatility in the markets. All right, so let's go on the chart, and let me show you what those indicators look like. So like I said, the first type of indicator that we are gonna talk about today will be the trend indicator. So in this case, you'll simply click on insert to be able to insert your indicators, and click on indicator. Then go on trend, and then you will be able to choose, in custom, and then we'll choose our indicators, which in this case was the MACD. So as you can see, this is the MACD, and the goal of this indicator is to show us if the movement of a currency will go up or down. And in this case, as you can see, for example, if we are here, as you can see, for example, there, well, the movement of the currency is up because the MACD, well, it changed. It went from here to there. And okay, this means that the MACD is currently going up until, let's say, this point here. So as you can see here, the MACD switched and it's going down. So here the MACD gives us a signal of a trend move. Well, it's gonna change. So okay, from here to there, well, we have a downtrend. Once again, indicators are not 100%, well, they are not 100% working. So you can't only rely on one indicator or a set of indicators. There are, just as I told you before, mathematical calculations that help you work with the charts and understand them better. But once again, you can't rely 100% on your indicators. All right, so as you can see, the MACD, the way it works, as I explained, it's very simple. You can look, me personally, the way I work with it, I look at histogram, and each time that the histogram changes, so for example, it goes from here to there, well, it means that the trend will change. So the trend here is here we have a downtrend, and the moment it changes, well, it becomes an uptrend. So from here to, let's say, approximately there, we are in an uptrend. So this is for our first type of indicators, which is the trend indicator. The next type of indicator that we are gonna talk about will be the indicator of momentum, and in this case we'll talk about the stochastic and the RSI. So let's just delete this indicator and let me show you what it looks like. So very simple, you simply go once again in custom and you can select stochastic, here we go, and RSI. You'll see both of them works, well, their goal is the same. Once again, it will show you when exactly the price of a currency is overbought or oversold. So just delete this because we won't need it anymore. All right, so both of them works the exact same way. So here you will have two lines by default when you open up your indicators. So as you can see, you have a line here and a line here. Same thing for the RSI, you have a line here and a line here. The moment that the price crosses this line, this can give you the signal, well, this can show you or tell you that the price is overbought. So here, for example, the price is overbought, and this means that you can, for example, sell your currency here. So the moment it's overbought, well, it's time to sell the currency. That's technically, once again, this is how works, let's say, the RSI or the stochastic. So as you can see here, for example, you can sell your currency. Same thing here. So for example, here, this means that the price is too high and it's time to sell. Same thing here. Here, what we understand is that the price is too low. It's time to buy. So here will be the moment to buy the currency. Once again, this is just, this is just once again a signal that the price is too high or too low. It's not necessarily it's not necessarily an indication to automatically buy or sell, but you can use this to confirm, for example, your trade setup. So for example, let's say you are planning to sell the markets, let's say, I don't know, somewhere here. Well, you can do it because the stochastic is, let's say, overbought. You have your confirmation with the stochastic as well because it's overbought. Or for example, you want to buy the market somewhere around here, and you did your analysis and you want a confirmation. Well, you can take a confirmation with the stochastic, for example, once again. So this is for the indicators of momentum. So as I explained you guys, those two indicators will show you that the price is too high or too low. And one other thing that you can do, the stochastic, what it's cool with it, is that it gives you a signal of buying or selling. Once again, it's not a perfect signal, but you can use it as an entry signal. So let's say, for example, the price here is oversold, and once the two lines crosses each other, well, this means that it's time to, it's time to buy your currency. So technically, if you trade only with the stochastic, here you will buy your currency. Here you will technically sell your currency. But once again, this is how this is how works the stochastic, but you can have a lot of false signals. But theoretically, this is how works the stochastic. So right now you understand it. All right, The next step of indicator that we are gonna talk about will be the money flow index, which is a volume indicator. So we won't need those indicators here. Here we go. All right. So simply go on indicators. In this case, you can go on volume and click on money flow index. So this one, his goal is simply to show you when there is a lot of money in, let's say, the market. So for example, here, it means that there is a lot of money injected in the markets. Right now, there is, let's say, a huge movement because there is a lot of money, let's say, in the markets. Here we have a low movement. A low movement can also be how we can say, it can also be a signal that it's a trend reversion. So for example, here we have a low movement on the markets. This means that it's maybe time for the trend to, let's say, reverse. So the price will probably go up, as you can see there, for example. Same thing, let's say, here. So as you can see, low movement. Once again, this indicator is not perfect either. And well, no indicator is perfect. So once again, you can use it to be able to confirm your trades. But the goal here, as I said, of the volume indicator is really to show you how much money there is in the market. So if there is a lot of movement in the market, a lot of money injected in the market, you can see here, for example, there is a lot of money injected in the market. And if there is no money injected in the market, so low volume, you'll see it here, for example, or here, for example, and the movement will be way smaller. The movement on the chart will be way smaller. So this is for the volume indicator, so the money flow index. But once again, I'm not gonna talk too much about it. The next one will be the Bollinger Bands, and it could be a volatility indicator. So let's insert it. Simply go on custom, and you can look for it. If it's not here, it's supposed to be in trend. So it can also be used as a trend indicator, but I personally use it as a indicator of volatility. All right, so the way it works, it's very simple. It's a moving average, so the line that is in the middle, as you can see it, is simply the line of the moving average. So in this case, you have your moving average of the past. Well, it all depends. In this case, it's the past 20 periods. So the past 20 candles, you have the price of the past 20 candles here. Here, it's the moving average plus 2 standard deviation. Here, it's the moving average minus 2 standard deviation. Once again, you can change it. You can put 3 standard deviation. You can put 1 standard deviation. The way it works is very simple. The moment that you see that the bands become wider, for example, here, as you can see, the bands became really wide. Or for example, let's say here, once again, you see the bands are really, really wide. This means that the volatility in the markets are huge. So there is a lot of risks of being in the markets. So this is, this is one of ways that you can use this type of indicator. Also, how you can use it, another way, will be to trade this indicator when the price, for example, touches one of the bands. For example, if the price is going from the moving average to, let's say, the lower band, well, this means it's a signal of buy. So it's time to buy your currency. If it touches the higher band, this means it's a sell signal. So you can sell your currency here. So this is the most popular way of using the Bollinger Bands. So as I explained, basically, it will show you how much there is volatility on the markets. Normally when it becomes wider and when the bands becomes closer, for example, here, the bands are really close. This means there is almost no volatility on the markets. And if you want to have your signal of entry, so your buy signal or your sell signal, it's going to be by trading on the bands. So for example, the higher band, you can open up a sell trade here. Or if, for example, the price touches the lower band, you can open up a buy trade here. So those are the 4 types of indicator that you guys can use on the markets when you are trading. And those are amazing way also to start when you start in the trading world, understand the price movement, understand how everything works. And as I said, what I'll ask you guys now to do, you can simply open them up and practice a little bit to trade with them. Well, not to trade with them, but just to spot price movement. So for example, you can open up the Bollinger Bands and just try to spot the price movement. And once again, as I said, they're not perfect. No indicator is perfect, and no indicator can make you $1 million. So those are just ways to help you analyze the charts. So you can just start with maybe the Bollinger Band, open up the MACD, try out the MACD a little bit, open up the RSI, the stochastic, and try those. And you'll see it's, they can work, but there are some times that they don't work. Once again, no indicator is perfect, and it's just to help you out with your trading. So that's it for this course, guys, and see you all in our next class. Hello guys, and welcome back to another class of our course about the complete introduction to Forex trading. So in today's class, we are gonna talk about, we will continue talking about technical indicators. And in this case, right now we're gonna talk more about price action and the price movements of the chart, more than just indicators. So the first thing we are gonna talk about in this course will be support and resistance and key levels. So how you can trade a chart and make a price analysis without even using, let's say, indicators or fundamental analysis. Well, two words actually, price action. And how this works, well, you will see it's very subjective. Each person trades can trade this very differently, but and can place its supports and resistance at different places. Once again, I'll explain you how it works. All right, so the first thing you guys want to do is open up your chart and find out a place, I don't know, where you can definitely see that that's a high. So for example, at this place here. Here I can place one of my supports. So support will simply be the highest price that I'm willing to, let's say, that I think the price will go in the near future. For example, if I'm a day trader, I think that the highest price that this currency will reach will be the price right here. And the same thing will go for, let's say, our resistance. So the resistance is simply the lowest price that a price can go in the near future. Key levels are levels where you have, those are levels of support and resistance, and those are levels where you have at least 2 points that are together. So for example, let's say I want to draw another support. So it's going to be here, and I have a key level here. Why? Because as you can see here, I have 3 points that are, that are tested. So in this case, let's say I'm in a situation, let me just zoom on it. Let me come back what I was. All right. Here. So let's say, for example, you are here. As you can see, the price has tested once, twice, 3 times. So if, for example, you are in a situation like this, you can use this point as a key, key level or a level of support. Yes, it has break the support, and normally when it breaks the support, you close your transaction. Another thing that I haven't really talked about in the past courses that I should have talked about in our past courses is the take profit and the stop loss. So in trading, you can, when for example you open up your transaction, let's say you open up a sell order here, and you want to place, you have a certain amount that you are willing to risk. Let's say you are ready to risk 20 pips on your trade. So your stop loss will simply be 20 pips higher. So you will open up your trade and you will write down 20 pips on your stop loss. So let me just show you where is it. So we have our market watch, and let's say you want to open up a trade. So you click on new order and it's gonna be here. So let's say, for example, I want to place my order at this price. So I will write down my price. So in this case, it's gonna be a pending order. I want to open up a sell limit, and it's gonna be at 1.9. So what's gonna 1.09, sorry. So this means that my price, my broker will open up a trade at this price. If I place, let's say, my stop loss at 1.095, this means I'm ready to risk 50 pips on my trade. So let's say I place a trade on my support here, and my stop loss is 50 pips higher. So this means I'm ready to risk 50 pips on my trade. So this is for take profit and stop losses. So let's come back to our support and resistance and key levels. So as I explained to you guys, key levels are simply levels where you think there is enough connections between, let's say, points, and where the price tested more than one time and haven't broken that level. So for example, it could be here. So as you can see here, for example, we can have a key level. So somewhere here, we have our key level because the price tested, but never broke this level. So you can just place your key level here once again, and then finally it goes up. Same thing here. So it tested, and if, for example, you are here, you can place your key level somewhere there. This is on the very, very short term, but it can also go on the long term. So normally when you make your Forex analysis and you want to place your supports and resistance, what I personally do, I start with higher time frames. So I will start with, let's say, daily at first, and I will place my key levels. So you can, but if you want to practice putting down your key levels, the first thing you guys want to do is start with a higher time frame. So you can go on a daily time frame or a 4 hours time frame. And then after that, simply put your key levels. So you zoom out, you find the lowest point ever, or the lowest point in the near future or past, and you simply put your levels. So you know that the price will almost never cross this price right here. Well, it's the lowest price for a high period of time. Then you can place your supports at other places. So as you can see, we can find out different key levels. So for example, here we can have a key level. As you can see, we have the price has tested here, here, here. It tested here. Other places we can have a key level here. As I said, it's something that is very, very objective, and it's just a way for you guys to be able to place your support and resistance. So let's say, for example, you open up your trade somewhere here, your stop loss could be there, and your take profit could be at the next key level that you find that out. Once again, it's very subjective. There is no perfect way to do it. You can do it with the big time frames, then small time frames. So when you make your analysis, the first thing you want to do is put on your key levels on higher time frames, then come back on lower time frames. So if you started with a daily, you can come back in an hourly time frame and do the exact same thing. So you simply zoom out, and then you find out the highest prices. Well, start with the H4, and you can just find out the highest prices, and you simply do the exact same thing. And at the end, you will have different key levels that you will be able to work with. So you start with the D1, so daily time frame, then 4 hours time frame, then you can go back to 1 hour time frame, and you will be able to have a lot of support and resistances. And as I said, this is a good way to start, to have a graph and to know exactly where you can place your stop loss, your take profits, and those are also good points, as I said, as reference points to be used to enter a transaction. All right, so this is for support and resistance. The next thing we are gonna talk about is Fibonacci. So Fibonacci, how it works. So once again, you will see it's very, very subjective. Normally, how you wanna use a Fibonacci is gonna go. You will go on insert and simply click on Fibonacci here. You'll use the retracement. So you will take the highest point ever and come back to the lowest point ever if you want to open up a sell order, for example. So theoretically, when you have a Fibonacci, you want to enter the trade somewhere around 61.8 because those are key levels for Fibonacci. So as you can see here, for example, I did it there, and one of my closest points, the point of reversal where the trade really came into execution, was next to 61.8. So as you can see, this is an amazing place where I can take my trade. So I could have took my trade somewhere here and places my stop loss somewhere around 61.8, which could have been great. So the Fibonacci, technically what it does, it simply gives you some key levels simply by you tracing a Fibonacci on the support and on the resistance. So on the highest point and the lowest point. So we can go and try it out on some other places. So we can simply go on the graph. Simply, let's say we are going here and we want to do it somewhere there. So let's do the exact same thing. Let's say we place it here. So as you can see, the exact same thing happens there. I want to open up, I want to find out where exactly I want to ride this uptrend. So very simple, I go from my lowest point to one of my first highest point. So let's say you are somewhere here. You go to one of your highest points and you can simply enter the trade there. You can do it the other side as well. So let's say, for example, you are starting here. You can put it down there. So highest point, lowest point. Once again, let's imagine we don't have those points. And you are looking for a place to enter. So you want to enter a short trade. If you want to enter a short trade, so a sell order, you're going to enter somewhere around this point. If you want to enter a buy order, so you are planning that the price will go up, simply do the reverse. So you want to enter at 61.8. And as you can see, you will enter the trade somewhere around this point right here. So as you can see, it gives you key levels. So you enter somewhere around this point and then you can simply ride the trend. But once again, you need to spot if it's an uptrend or a downtrend before. But what Fibonacci does, it gives you very interesting key levels that you can use to be able to open up your trades. So everything around the price action and the chart figures as well around price action is really key levels. So key levels is really the word that you guys have to remember. So Fibonacci, what it does, as I said, it really gives you out key levels. The next thing that we are gonna talk about are chart figures. What this is, those are simply chart patterns. So you have patterns, candlestick patterns that exist that usually what they does, they tell you if the price will change. So for example, if the price will go up or will go down. So one of my favorites and one that I use a lot, I will show you just one because there are hundreds of them. You can simply look them on Google. You'll see there is hundreds of them. But just for you guys to understand what is it, that's my main goal, is when there is, for example, if I want to spot if the chart's gonna switch, I simply look at, let's say, situations like this. So right there, perfect, exactly. All right, so as you can see, what's happening there, you have a small sell, you have a small short candle. So you have the candle of that the price went down, and then you have a candle of the price going up. So what's happening here? Well, the candle of the price going up is at least 75% bigger than the candle of the price going down. So here, for example, I would have opened up my buy order. So for example, here I would open up my buy order. Same thing here. For example, here, as you can see, I would open up a sell order. If I strictly stay with this strategy, here I would have opened a sell order. I would have done the exact same thing here. I would have opened up a buy order here because this candle is bigger than, well, is at least 75% bigger than this one. Same thing here. I would open up a buy order there. So as you understand that right now, this is what those patterns are. So as I said, there are hundreds of patterns that exist about chart figures. Some works more, some works less. But once again, one of my favorites is this one. So as I explained, you can simply try to look at it on charts. For example, here we have a clear example of it. So right here, for example, we have a small sell candle and then we have a big buy candle. So here, for example, I would have entered my trade and I would ride the transaction. So you can try it out by yourself. If you want to look at other candles like this, you can. There is a lot of them that exist. I won't show you all of them that exist and show you examples of it. It's very simple. You simply look for them and you can try it out on your graph. This is another way, as I said, to be able to check and make a graph analysis, well, a currency analysis by looking at those chart figures. All right. The next thing that we are going to talk about are trend lines. Trend lines are very important as key levels, which are very, very important. So we'll just take out our key levels. So how do you trace trend lines? So let's say, for example, let's just take the beginning of this trend because we clearly have a trend here. Let's say I'm somewhere around here and I spotted that there is an uptrend. How do I spot this? Very simple. Let me just get back where I was. Right, somewhere here. Good. So I'm somewhere around there. what do I see here? If I want to spot an uptrend, what I want to spot first, what I need first, I need two max levels and the two min levels. So two minimum levels and at least two maximum levels. So here, for example, what I see, here I have, so here the price stays the same, so it tests here, it comes back up, tests, come back up, and boom, here I have first min. So I still don't know that the price will go up. And then what I see, oh, so the minimum went from here to there. So what I can do now, I can trace my first trend line there, this way. So as I can see, the price is still going up, so the minimum is going up. And then what I see, the max is also going up. So what I do now, when I have 2 points, so a minimum of 2 points, I can simply trace my max. And from this moment, I'm able to see if that's an uptrend or a downtrend. So for example, here I had my 2 points traced. And from here, from this moment, I'm able to make my trade. So for example, each time that the price reaches this trend line, I can open up a buy order. For example, here I can open up a buy order. I can close it here, open up a sell order here, open up a buy order here. So as you guys can understand, then I can do this on, well, here it's gonna be a small trend. So once again, we have our 2 points there and our 2 points somewhere around here. And from those 2 points, I can find out that this is a downtrend. So once again, the more the trend advances, the more I will adapt my trend, and the more it's gonna be easier. So as you can see here, we have a small downtrend. All right, so right now, let's say we are looking for bigger trends. So we will work with the mins that are way, let's say, different places, one from another. So we are on a 4-hour trend. Once again, it's very, very huge. But let's say we want to use this point as our first min and this point as our second min. We can. So each time that the trend reaches this point, we'll simply open up a trade. So as you can see what we just did, our first min is here, our second min is somewhere here, and we have maxes. So once again, our first max would be somewhere here, our second max would be somewhere here, and then we know that we have an uptrend. And from this point, boom, we have an uptrend. And if we want a confirmation, we can do it simply by going on a daily chart, for example. And as you can see, well, we have our confirmation of an uptrend. So very simple. What I want you guys to do, simply spot 2 points. Let's say I'm trying to make an analysis on today's day. So I'll go back here. I will spot 2 points. So let's say, for example, I'm here. I have my support. I have my resistance. And where I think exactly the price will go. For example, what I can do, I can simply put, well, here what I see, I personally see a downtrend until here. And what I'm planning of the price to happen, for example, here we have a downtrend, it comes back up, comes back down, comes back up. So we have a triangle once again. Well, here in this case, we would have a triangle. And what I'm planning that the price will do, the price will simply cross on this point right here. So as you can see, I just traced trend lines, and my goal is really to, once again, speculate that the price will do something at this point, because I traced 2 trend lines, I have a triangle, and here, let's say, for example, for me, the price will go up. But what I'll ask you to do, guys, to practice tracing trend lines, simply spot 2 points together. So for example, you spot 2 maxes, you can simply trace a trend line. So boom, here you have max 1, max 2. Then you will have min 1, min 2, and simply trace your trend line. And simply practice tracing those trend lines. If you wanna work like more efficiently, what you can do also is do it this way. So simply take your graph, then simply bring it really far back down and advance slowly. Let's say, for example, you are here. Okay, what I'm seeing 2 mins. I'm gonna trace my trend line here, for example. All right, I'm right, because the price went up. I have 2 maxes here, so I'll trace my trend line here for my maxes. All right, I can fix my trend line, my second trend line. I can fix it because the price moved. I was right. So this is how you practice putting your trend lines, and simply advance until the today's date and look if you did it the right way, and simply trace trend lines everywhere. Once again, that's an excellent way for you guys to practice tracing trend lines. All right, so right now what we saw for our course about price action, the first thing we talked about are support and resistances. Very important for you guys to do. So don't forget to practice it. Once again, simply open up your graph on a high time frame, so you can start on a daily time frame. Put your supports and your resistances. Then you simply go back on lower days, so 4 hour, 1 hour, 30 minutes, and put on your support and your resistances. After that, you can put your take profit, your stop loss. Next thing that we saw is the Fibonacci. And once again, we saw really fastly how it works. You can also practice your Fibonacci. So for example, here, if I want to trace a Fibonacci, I will simply take my first point from here to here and look at the 61.8, which is my key level to enter the trade. Next thing we talked about are chart figures. So in this case, we talked about only one, but there are hundreds of them. If you want to find them out on the internet and simply practice trying to find them on the graph, you can. I personally don't use them this much, but you can. It's very well. It's an important part of trading also. And finally, we talked about trend lines and how to draw trend lines. Once again, it's something that is very, very subjective, and each person will draw trend lines differently. So this is right now up to you to practice drawing trend lines. So that's it for this course, guys, and see you all in our next class. Hello guys, and welcome back to another class of our course about the complete introduction to Forex trading. So in today's class, we are gonna talk about combining indicators and price action to be able to create a certain strategy. So how we will do this? Well, very simple. For the purpose of this class, we are gonna work with 3 indicators, which will be the first one, simply click on insert, will be the MACD. So simply go on custom and look for MACD. Here we go. The second indicator will be the RSI. So same thing, simply choose RSI. And finally, we will use the Bollinger Bands. So my goal here is simply to present you one way that you guys can trade by using indicators and also price action. All right. So let's say we are using those indicators. Our goal here is to find out, we'll create a basic strategy. And our goal here will be to create something that will use those 3 indicators together. All right, so let's say, for example, we are using only the MACD. So technically, when the MACD point is pivoting, we will enter the trade. We'll open up a sell trade here. But if we don't have a confirmation of the RSI and the Bollinger Bands, we will simply not get in the trade. If we have 2 confirmations, so let's say we have 2 confirmations on 3, well, we can think about taking the trade. All right, so let's say, for example, we are at this point right here. So right here, what do we see? We see that the Bollinger Bands are at the top. We see that the RSI is at the top also. So we can say that this place is overbought right here. And we also have our point, well, our candle that touches the highest, well, that touches the higher band of our Bollinger Band. So this means that we have a confirmation of 2 indicators. We can wait till we have a confirmation of those 3 indicators, but in this point we have a confirmation of 2 indicators and we can take the trade. All right, so next thing that we want to do is simply put our support and our resistance. In this case, our highest point is the point right here. Our lowest point is the point right here. And what do we see? Well, what we can do right now with all this information, we can set up our stop loss and our take profit. So in this case, we can put our stop loss a bit higher than our point right here. For example, we are somewhere there. We can put our stop loss somewhere here, around there. and our take profit somewhere in between. So let's say we put our take profit at the middle band. So what does this mean? This means we have a risk reward that is very interesting. So in this case, we have a risk of 15 pips and a reward of around 178 pips. So it's a risk reward of 1 for 10, something around that. So as you can see, it's an interesting trade and we can take it. In the case of if it didn't work, well, no worries. We had a risk reward that is very high, and this means that at the end we are still going to be profitable. We can try to do this at another place. So let's say, for example, we are trying to find a place where we have a confirmation of those 3 indicators, which can be very, very hard, since they don't always, they are not always confirming the 3 of them. Let's say here, for example. So what do we see here? Once again, we have a confirmation of 2 indicators. We have the RSI that there is very high, and also we have our Bollinger Bands that are at the top. So as you can see here, our RSI crossed at this point here, and it touches our Bollinger Band somewhere there. All right, so we can open up our trade somewhere around this point. So once again, we are at this point right here. Technically, if we see all those candles, our support will be somewhere here. But let's say that we are somewhere right there. So our point is right here. Let me just come back to it. So we are here. Technically, we can't see this point. So right now we don't see the point. We can't see this point. Simply going back to our point. All right. So let's say we are there. So we have our support. Our support theoretically will be the highest point, and we are at the highest point. So our support will be somewhere around this this bar here. Our resistance will be our lowest point. So in this case, our lowest point of past charts will be somewhere there. And once again, we can open up our trade somewhere here. We can place our stop loss somewhere around there. So once again, we'll have a good risk reward. And our main goal will be to close the trade at the middle band. So at the moving average, we close the trade. So as you can see, once again, we have a profit of 166 pips. And our risk for this trade was something around 52 pips. So once again, it's a risk reward of around 1 for 2, which can be very, very interesting. In this case, we had a loss because as you can see, the trade went down. And what happened after that? Well, it didn't came back up. So it came back up and it didn't work. So we hit our stop loss. So as you can see, this is one strategy that we can use. There is plenty of others, but once again, it's just a way to show you guys that you can put together price action and indicators to be able to create a strategy. Let's find out another place. For example, let's say somewhere right here, which is a nice place. Once again, the RSI is at the top. Once again, we only need like a confirmation of only 2 indicators. So as you can see, the RSI is at his top. And we have our Bollinger Band, we have our band that is touched, our upper band that is touched. So here, technically, we would enter the trade somewhere around this point or this point. And our goal will be to place our stop loss somewhere higher than this point. So our stop loss would be somewhere here. And once again, our take profit would be somewhere around around the moving average. So here it touches the moving average. In this case, we would make a profit. So our take profit would be here. Our stop loss would be here. And we had a risk reward of 40 for 250. So a risk reward of approximately 1 for 5. So 1 pip of risk and we get 5 pips of reward. Once again, we didn't really use the MACD because we only used the Bollinger Bands and the RSI to find out our entries. But once again, it's a good strategy, you can wait for a moment where the three of those indicators are together, are working together. They are confirming the movement of the chart. Once again, sometimes it's gonna take you a lot of time, so you can just work with 2 indicators on 3. But it's possible to add more indicators. Once again, having too much indicators, it's like having not enough of them. So your goal when you are creating a strategy, it's having something that is simple and that can be used. So here we have a place where almost all our indicators are respected. So somewhere around here, yeah, maybe not. Yeah, well, so as I said, it's really complicated having all the indicators that are respected. So to have a confirmation with the MACD, a confirmation with the RSI, and a confirmation with the Bollinger Bands. And the more indicators you have, the more it's gonna be hard to have a place where all indicators are respected, where all indicators will tell you to go in this direction, for example, once again. So if you want to try out this strategy, very simple. You simply open up the MACD, you open up the RSI, and you open up your Bollinger Bands. You'll see you will use mostly the Bollinger Bands and the RSI to confirm your trades. The majority of times, this is when the trade will work, when you use the RSI and the Bollinger Bands. How you can use the MACD if you are not able to find trades that have MACD as a confirmation. If, for example, let's take this trade right here as an example. So for example, you open up your trade here because the bands are touched and also your RSI is very high. You want to look at the MACD, and the moment that the MACD changes, for example, it goes from a very high MACD to a bit lower on the histogram, well, it's your signal. So for example, instead of entering here, you can enter, let's say, somewhere around here, because here is the point where the MACD goes a little bit down. And this is the moment for you guys to take the opportunity and simply sell your position. So once again, you'll work the exact same way. So let's say here will be our stop loss. Here is our point of entry. And so here will be our entry. And somewhere around here will be our take profit. Since our goal is to close the transaction when the trade reaches the middle band, so the moving average. So we have a risk reward of around 1 for 2. So 1 for 2, 1 for 1.5. So as you can see, guys, this strategy, this is an example of strategy. It doesn't always work, but the main goal is for you guys to have something that is profitable and that can bring you money on the long term, not on the short term. So that's it for this course, guys, and see you all in our next class where we will talk about money management. Hello guys, and welcome back to another class of our course about the complete introduction to Forex trading. In today's class, we are gonna talk about money management, which is a very important concept to know to be able to succeed in the trading world. So let's start. All right, so the first thing that we are gonna ask ourselves is, what is the definition of money management? Theoretically, money management, the complete definition is that it's a crucial element of trading the financial markets, especially in times of volatility. It's a defensive concept that keeps you in funds so you can trade another day and underpins profitable performance. On a basic level, it tells you if you have enough new money to trade additional positions. This is the definition, like the theoretical definition of money management. Now, what all this means? It simply means that it's the way you will manage your money when you are trading. For example, if you open up 2 large positions, yes, you can make a lot of money, but at the same time, you are exposing your account at a high level of risk, and you can lose absolutely everything on one single trade. So technically, this is what money management is. Now the second thing, which is the concept of risk per trade, we can see it as the concept of risk reward. So how much you are risking versus how much you are ready to gain on your trade. So let's say, for example, you are risking 5 pips. Well, are you expecting to gain 10 pips? If you are expecting to gain 10 pips of your trade, this means your risk reward is 1 for 2. So basically, you can lose 2 trades, and you will still be profitable if you win just 1 trade, or you will be at break even at least. Then you need to also take in consideration the your risk reward, and also what is your winning rate. If let's say your risk reward is 1 for 100, but at the same time your winning rate is 0%, well, this means you will never make money, even if your risk reward is huge. So the thing here, when you are creating your trading strategy and you are trying to have a good money management, and you want to see the concept of risk, you want to really talk in depth about the concept of risk, well, the thing is, you should not risk more than 2% of your account per trade. Which means, for example, if you have a $1,000 account and you are planning to risk 2% on your trade, which is, let's say, 10 pips, so you are having a risk of 10 pips. So 2% of your account will be equivalent to 10 pips. In other words, let's say, for example, you have a $1,000 account, 2% of 1,000 will be $20. So you will risk $20 on 10 pips. And to risk $20 on 10 pips, well, you should trade 0.2 of volume. So your volume of trade will be 0.2, your risk will be 10 pips, and your reward, let's say you want a reward of 30 pips. So in this case, you have a risk reward of 3 for 1. So you have to take all this in consideration. But as I said, for your risk per trade, you should never, ever, ever go more than 2% per trade. So even if you want to risk, let's say you want to have a risk of, let's say, 100 pips, well, you should put 2% in those 100 pips, never more. Because at the end, it's your capital and you have to protect it as much as you can, especially when you are starting out in the trading world. All right. Next point is the margin. So we are going to talk also about the margin here, and why the margin is a double-edged sword. So as I explained you guys, the margin is simply how much money the broker will give you for each dollar invested on the Forex exchange, or on each dollar that you deposit on your account. So let's, for example, say that you are depositing $10 and you have a broker that gives you that gives you $20 for each dollar that you deposit. So if you deposit, let's say, $50 on your account, this means the broker will give you access to $1,000. So this is basically how it works. It's very cool because you have the power of trading of $1,000. But the problem with this is you still don't have that much money. And if you lose more than your capital, well, you will simply blow your account. So let me give you one example. Let's say, for example, you are trading you have $1,000 in your account right now, and you decide to open up a position with a volume of 1. In this case, let's say everything goes perfectly. Right now you are going full margin with your account. So let's say everything goes perfect, and your trade, let's say you open up your trade and you make 100 pips of profit. This means you just made $1,000, which is great. You made 100% profit on one trade. But right now, let's say, imagine that instead of going up 100 pips, it went down. Not even 100 pips, but just 50 pips. Well, you just lost 50% of your account. And to go from that $500 that is left on your account to come back to 1,000, you'll see it's going to be really hard. So you don't want to use the margin too much. You have to use it, but don't over leverage your trading. If you are over leveraging your trading, well, you will simply take risk that is nonsense, risk that doesn't make sense, and at the end of the day, you will simply blow your account. So be very careful about the margin that you are using. Even if the broker gives you access to high leverage and a lot of margin, well, don't use it all. Next thing, never change the rules of your strategy. So that's an very important thing. In the next classes, we are going to learn how to create a Forex strategy. And when you will create your own strategy, the thing is you will have back-tested the strategy. You will have created your strategy. The strategy will be back-tested. The strategy will be confirmed. Yes, when you will trade the strategy will not always bring you money. And yes, you will have losing streaks. So you will lose maybe 4, 5, 6 times in a row. But the thing is, if you start changing the rules of your strategy, you don't know if those new rules will work. And if you are starting trading with your emotions, well, once again, you don't know if this will work as well. And a good way to blow your account is constantly changing strategies. So you try out a strategy, doesn't work, you try out another one, you try out another one. Every strategy will lose. There is no strategy that exists that brings you money, let's say 100% of time. The majority of good, very, very good strategies will bring you money, let's say 70 to 75% of time. It will have a risk reward of around 1 for 1.5. So that's considered a very, very good strategy. And once again, if you start thinking about strategies that give you a risk reward of, let's say, 1 for 100 and they always win, they just don't exist. So you should be very, very careful about this. When you create your strategy, think wisely and don't try to create, I don't know what kind of strategies. Be wise. And the type of strategy that you want to create is something that makes sense. So risk reward of maybe 1 for 2, 1 for 3. And try to have a winning rate of around at least 50%. With those, if you're able to generate one strategy to have a risk reward of 1 for 2, 1 for 3, and you are winning 50% of time, well, you will be very, very, very profitable on the long term. So finally, to summarize all this, as I explained, the concept of risk per trade is don't risk more than 2% of your account. You understand what are the other aspects of risk and why not risking more than 2%. The margin, don't over leverage your account once again. This comes with the 2% per trade. So don't start to over leveraging. Don't use the full margin because you'll see you will not only it will not make you money on the long run, but also it's gonna stress you a lot on the short run. And there is a lot of chances when you are stressed that you will blow your account. And finally, never change rules of your strategy. So when you have a certain strategy that you created, that you spend time backtesting, creating, and analyzing everything, it's not the time to change it because of maybe 1 or 2 losses. So that's it for this course, guys. Right now you understand what is money management. See you all in our next class where we are gonna talk about creating a Forex strategy.